Hi everyone, I'm Tonjiro Caroline, and in this video I'm looking at discussing my research questions, the data and the methodology that I intend to use. I'm looking at institutional investor heterogeneity and stock return predictability, evidence from investor domicile and investment horizon. And I'm looking at answering these two research questions. What influences the buying and selling behavior of different institutional investor groups, and are some groups of institutional investors more informed than others? So I started by looking at previous literature that has examined these two institutional investor characteristics in isolation. Looking at investment horizon, previous literature has disentangled institutions into short-term and long-term institutions and examined their impact on stock prices, on stock returns, and also on other corporate decisions. For example, Yan and Singh, they examine whether short-term or long-term institutions are informed in their trading, and they find that only short-term institutions do have predictive power in predicting future stock returns. And they thus conclude that what has been documented in previous literature, for instance, by Gopas and Matrick, that institutions are informed in their trading, it can only be explained by short-term institutions, while GASP and others, they find that short-term institutions do foster mergers and acquisitions, but at a reduced premium. Then Kim and others, on the other hand, they show that long-term institutions are in position to promote corporate innovations. So generally, past literature on investment horizon is mixed between the short and long-term institutions and their ability to influence various corporate decisions. Then I also looked at past literature on institutions domicile. Most of the previous literature have documented that distance can be used as a measure to proxy information advantage. And they've shown that institutions that are closer to the firms do have an information advantage, whereby they can casually interact with either CEOs, employees, or managers of those different firms, and they are in position to gather important information, and such information can be used in their trading, which is a disadvantage to institutions that are located far from the farm. For instance, Beck and others, they document that local institutions do outperform non-local institutions looking at the US market. Then Ferrer and others, looking at an international perspective, they document that local institutions do outperform foreign institutions, especially in weak capital markets that are full of information asymmetry and in liquid stocks. On the other hand, Cheng and others, they do document that foreign institutions do have an edge over domestic institutions. And they show that foreign institutions can also have an advantage of their global interactions, and they are in position to benchmark at a global level, thus outperforming domestic institutions. So generally, literature on these two institutional investor characteristics is mixed. And in my study, I intend to interact these two institutional investor characteristics so that I might be in position to come up with better intuitive understanding of how investment horizon and institutionals domicile do impact on the trading and selling behaviors of different institutional groups and in terms of their predictive power of returns. Then looking at a recent paper by Kim and others, they study a joint analysis of investment horizon and portfolio concentration. And in their joint analysis, they show that short-term concentrated institutions are more informed in their trading compared to short-term diversified institutions. So they thus conclude that what has been documented in the previous literature, for instance, by Yang and Zhang, that short-term institutions are informed in their trading, that such can only be explained by short-term institutions that are concentrated, not short-term institutions that are diversified. So basically, following the same approach, I intend to examine institutions that do have similar investment horizon but differ in their domicile, to see whether I can come up with better intuitive results in explaining more about institutional investor heterogeneity and stock return predictability. The purpose of this study is to examine the buying and selling behaviors and return predictability power of institutions with similar investment horizon but differing in their domicile. And looking at the data and the sources, I'm looking at 3 data sources. One is Thomson Reuters, which will provide me with institutional level data on institutions' holdings. Then I'm looking at CROSIP. In CROSIP, I'm getting firm level data on different firm characteristics such as stock returns, prices, trading volume, outstanding shares, among others. Then from Compasstat, I'm getting data on book value and cash dividends. And I'm looking at a study period from 2000 to 2020. In constructing my variable of interest, I'm looking at interacting these 2 institutional investor characteristics. And following Yang and Zhang, I compute the average churn rate and use this average churn rate to categorize institutions as either short-term or long-term. I classify institution to be short-term if it is in the top 30 tensile of the average churn rate. And also categorize institution as long-term if it is in the bottom 30 tensile of the average churn rate. Then to categorize institution as domestic or foreign, I follow Ferreira and others. And the fact that I'm using stock from US market, that means that institutions that are US and are investing in this stock are domestic, while global institutions investing in the US are foreign institutions. So I interact these 2 institutional investor subcategories, and I'm in position to come up with 4 institutional investor groups, which is short-term domestic, short-term foreign, long-term domestic, and long-term foreign. So having these 4 institutional investor subcategories, I'll be in position to compute their percentage shareholding at each quarter in a firm, and using their percentage shareholding, I will be in position to compute their changes in trading so that I'm in position to test their selling and buying behaviors. Then I will also be in position to use these 4 institutional investor subgroups to examine which of these 4 institutional investor subgroup has better predictive power in predicting future stock returns. So basically, using these 4 institutional investor subgroups, I will be in position to answer my 2 research questions. So that is it for now. Thank you.